think, act, and prosper. You are now tuned into the Money Level Show.
Hey everyone, welcome back to the Money Level Show, where we think, act, and prosper. And today we are joined again with the man himself, Alasdair Macleod. What's been going on?
What's been going on? Well, I mean, in the words of one of my old friends in the stock market, who never knew how to answer it, he said, "More buyers than sellers." But I think actually that's true. No, I mean, well, that's precious metals. There's, I mean, as far as demand for gold and silver, it's really all in the futures market at the moment. I mean, we see not a lot of demand overnight from Asia now, but quite clearly the pairs trade, by which I mean what the hedge funds do is they buy gold, sell dollar, or or sell gold, buy dollar. They never take delivery. They're just literally out of one in the other, and then they reverse it. I think they're beginning to get really concerned about the outlook for the dollar, and the cut in Fed funds rate recently, 50 basis points, I think sent a very clear message that the Fed is now less worried about inflation and more worried about the prospects of a stalling economy, even though that wasn't said in the FOMC statement by Jay Powell. So on that basis, and also if you look at the chart for the dollar's trade weighted, there's something called a death cross, which is very, very bearish. Basically, what a death cross is you get the price underneath the moving averages, with the shorter moving average, in this case, we're looking at the 50-day, 55-day moving average, crossing down and accelerating now under the longer term 200, 250-day moving average. Now, what that tells you is that the dollar's trade weighted is very definitely in a bear market. And I think when the 100 figure, I mean, at the moment it's at 100.5 or something, when that 100 figure gets broken, I think all hell's going to get loose. So what the hedge funds, the pair traders are doing is they're anticipating this event. So this does give us the potential maybe for, if we get a little bit of a bounce in the dollar, perhaps you will see the gold futures values ease. So there could be a little bit of a correction, but I don't think it's going to go very far, because actually what these pairs traders are doing is they're not so much buying gold futures, but they're selling the dollar. Now, this is a very, very important distinction. That's what they have in mind. They don't want to have the dollar. They think the dollar is going down. And, they can go and buy sterling. They can get, which they have been. I mean, sterling's been pushed up to 134-ish, something like that. They can buy the euro, they can buy the yen. And the yen's had a good little run today, which has undermined the Japanese stock market. But the principal thing, because all those currencies have the same problem as the dollar at the end of the day. So the principal way out of the dollar actually is to just get the hell out of credit, which is what the dollar is, and go into real money, which is what gold is. And of course, silver, with a gold-silver ratio, as I look at it at the moment, around about 84, this is way underpriced relative to gold. So, silver was breaking out into the highest levels since the middle of 2012. Yesterday, it breached the 32.5 level. I mean, it's drifted back today, but do we take this seriously? I mean, basically, ahead of the weekend, there are always people who don't want to have open positions over the weekend. So, if you're short dollar, long gold, you've got a profit, what you do is you take your profit and you say, right, Monday's another day. And consequently, we've got gold, which has been as high as 26.85, I think. It's now drifted back to a little bit under 26.50. Silver from that peak, it got up to 32 and 70, I think, and we're currently 31 and 51. I mean, this is ahead of the weekend markdown, if you like, and perfectly normal, nothing to worry about. So that's roughly where we are. I think it's, the key points are that the demand at the moment isn't so much from the Far East or Asia. I mean, they're still taking out physical when they can. But I think the price drivers have really been the hedge funds who have woken up to the Fed's dilemma. And the Fed has chosen to, try and deal with prospects for a falling stock market, a declining economy, rather than tackling inflation. Inflation has not gone away. That is going to continue to be a big problem.
Mm-hmm. Yeah, that's really good. So I've noticed what I'm noticing is that gold is and silver are both performing very well, and this isn't like in the midst of a, I guess, crisis or bad news. And so, like, thinking about the global financial crisis, gold and silver were spiking during that time, and that was like heavy bad news that was shared, and you saw the price going up, and now we're in the environment of, I guess, quote unquote good news, and gold and silver are elevating to highs measured in dollars. And so what happens if the stuff hits the fan?
Forget bad news.
What happens when the stuff hits the fan? Hello, everyone. Excuse the brief interruption in the interview, but I want to tell you about my new newsletter called Money Levels Insights. By subscribing to this free newsletter, you will gain access to premier content, technical trades that I am making, and insights to the macro landscape. Also, I interview a lot of industry experts that provide me information off camera, and I would love to provide you all with some of that information that is given to me. So be sure to click the link in the description so that you can get on the list for this free newsletter that is going to be coming soon. Thank you all for your support. Now, without further ado, let's get back to the interview.
Well, I mean, first of all, I just want to correct what happened in the great financial crisis is that everybody went for safety. Now, in those days, safety wasn't gold. Safety was the dollar. And the result was that gold fell from over $1,000 an ounce down to, I think, something like 680, really quite quickly. But, once that initial shock had passed, gold started powering up, and it was hitting new highs for the next 2 years and ran up to a high of 1924, something like that. I think that was September 2011. So this is fundamentally different. Now, you're right, we don't have a visible crisis at the moment, but there are a number of things in the background which, just because it hasn't sort of hit the headlines, we are aware that there are problems. We look at the central bank's balance sheets. They're heavily into negative equity. We look at the situation for the commercial banks. They are highly leveraged and therefore vulnerable to any shock. We have inflation is a continuing problem. And if you look at the budget deficits, and particularly if we get a downturn in the economy, they're just going to run away. I mean, and that is the source of inflation. Another source of inflation, of course, is excess consumer spending. And if you look at what the consumers are doing, they've tapped out their savings, and they've increased their credit card debt. So basically, everything is still driving prices higher, even though the economy is in, if you like, not very good shape. So overall, on that side of things don't look that smart. And then if we go internationally, you can see that the dollar has a problem because the Chinese and the Japanese are no longer buying US Treasury debt. The Chinese in particular are doing what I've just said the hedge funds are now doing in America. They've been selling dollars. And guess what? They've been buying gold. And so have the Chinese citizens. So have the Indian citizens. Now, I think that's died down a little bit now. But, it's the idea that the U.S. Treasury is going to be able to fund itself from foreign demand. Forget it. That's not going to happen. It really is not. Now, this means that the U.S. Treasury are in a debt trap. And we can see this. So, okay, we don't actually have a visible, sort of huge, great Lehman moment, but we can see that there are these problems. And then, of course, you've got the Ukraine. I'm actually getting a bit more positive on the Ukraine. I think that we'll probably move towards peace negotiations because quite clearly, the American strategy of trying to undermine Russia through Ukraine has failed. And I think where the, not necessarily Biden, I mean, there's, he's no longer really in the picture, let's face it. The White House isn't really in the picture. This is being run by the Pentagon. And I think the Pentagon is now trying to work out how can we gracefully exit from the Ukraine problem. So that, to me, I think is a positive. On the other hand, you've got Netanyahu in New York at the moment, trying to drum up support for an attack against Hezbollah in the Lebanon. He's effectively, I think, squashed Hamas in Gaza. That is no longer his problem. His problem is Hezbollah. And of course, behind Hezbollah, you've also got Iran. So this is something, what Netanyahu wants is he wants American troops on the ground. And we've sent troops into the region. They're not quite on the ground yet. We've sent troops into the region. But we have taken our citizens out of Lebanon. I mean, we've said, right, you got a British passport? Come on out. This is obviously on the basis of intelligence. Whatever you and I say about the situation, the Foreign Office and your equivalent in America is basically trying to get our nationals out because they know this is escalating into something more dangerous. So that is still a very live problem. So Ukraine, okay, but I think that and it's actually too early to say that the situation is okay in Ukraine. I mean, it really is. But I'm just sort of seeing that there's they've got to find a way, if you like, of exiting this gracefully. So that to me is a positive. You've got the problem, and it's a huge, great problem with the Middle East, because if Iran gets into this, they'll close the Straits of Hormuz, and then the price of oil is, well, think of a figure and double it. I mean, we could be looking at $200 a barrel easily. So, that's not a sort of shock that we actually want. And I think this is why, actually, the Allied forces, NATO, America, Britain, whatever, are holding back and desperately trying not to get sucked into this conflict. So that's roughly where we are. I mean, there all these huge, great problems. We know the problems are there. We know that the foreigners are no longer buying US treasuries. And perhaps, while foreigners understand that the US government is in a debt trap from which there is really no escape other than really slashing government spending way down. I mean, surplus immediately next year. That's the only way out of this. On that basis, I think it's not just foreigners. I think some of the institutions, some of the investing institutions, hedge funds, and so on and so forth in America are actually getting worried about this funding problem. They can see it. I mean, they've been reading my stuff, I'm sure, and others, not just me, but And indeed, I mean, these guys are not idiots. They play the markets and all the rest of it, and they may be Keynesian and they're all into macro, this and all, but actually they're not stupid. So what we're going to see, I think, is a growing realization in the investment establishment in America that America has got a problem. And it's not just the foreigners looking at it, it's American institutions seeing this as well. So who needs a crisis? This will generate a crisis. Of that, I'm absolutely certain. And to an extent, if you're running, funds in America, you'll be looking at this and thinking, well, we got to de-risk our portfolios. So what do? Get out of credit. get out of credit. That's my new mantra. And the only way you get out of credit is to get into real money. And guess what? Real money is physical gold, either in possession or held, if you like, by a reliable custodian out of the banking system on your behalf.
Yep. Yep.
There we are.
Yeah. So there's no shortage of crises, and there. I'm just thinking about the Middle East in terms of right now. The United States, our defense spending is, close to $1 trillion, about 920 billion, and I mean, if we get involved in even more in the Middle East, or even send any troops on the ground and such, I mean, that number's going to balloon. Like it's like we're already at $1 trillion there, and then we're going to have to fire up the printing presses and print more to fund more military spending, or to send more weapons, or however they do it. And so I could just see that deficit going extremely higher, if something like that happens.
Yeah, undoubtedly you're right. But I don't think that's the main problem. Defense spending is part of just overspending, if you like, generally. And you could argue that a nuclear war would mean less spending because it would wipe out quite a lot of your own stuff. But no, we mustn't joke about these things. I think that the problem is far deeper than just defense spending. The problem is that debt is now escalating. You've got an economy which is not performing, which basically means that the tax revenue is coming in at a slower pace than the accumulation of debt, bearing in mind that the interest on that debt rolls up within the debt. I mean, the US government doesn't pay interest. No, it just rolls it up. So that's bad news. And, the inflation outlook, to my mind, at the very least, this is a repeat of the 1970s. And this time, America is so much more on the firing line than we were. And I'd like to remind your viewers that in 1980, the yield on the 10-year US Treasury note was approaching 15%. Think what that would do to the debt mountain. Think what that would do to the way it accumulates, because they roll up that 15%. Now, I mean, it's clear that one of the dangers is that the U.S. Treasury has become very reliant on short-term financing. This is T-bills, if you like. 90 days, 6 months, maybe a bit out from there. They haven't really tested out along the yield curve, so they've withheld supply from the yield curve, which tells me that if they normalize their funding, then that yield curve wouldn't be so negative as it is now. It'd probably even switch into positive. Why? Because nobody is prepared, other than the pension funds who have to subscribe, let's face it, and also to a smaller extent the insurance companies. I think that there are no other buyers out there, really, for US Treasuries out along the yield curve. Everybody's trying to de-risk themselves. So, again, referring this back to gold, if you like, the yardstick in terms of the risk-free investment was US Treasuries. It's no longer the case. And I ask my American friends, I say, this is something that is acknowledged by the government, and indeed has been stated in if you like, evidence to Congress and all the rest of it, that the value of the dollar depends on the faith in the U.S. government. What's your faith in the U.S. government like today, Mr. Darrell? Do you see what I mean? This is something which is eroding, and I think that there is a growing realization that the risk-free position actually is physical gold, not U.S. Treasuries.
So many people are putting their faith in one candidate or the other for the U.S. election coming up. And my take is deficit spending isn't going to stop. National debt's going to continue to increase. They're not going to cut entitlements. I mean, I'm looking at the largest budget items. I mean, Medicare 1.8 trillion. Then you have Social Security about 1.5 trillion, and military, then interest expense. And so that no who's going to vote for anyone that's going to promise cuts to these
Yeah.
entitlements? And so I just see that both candidates are going to continue to run up the deficits. And for me personally, it's like, okay, well, I need to look out for me and my own household. Like, and so that's why I'm still purchasing gold today. Like even at all time highs measured in dollars, because I there's just so much uncertainty, and the thing that I know for certain is that neither one of these politicians are going to cut spending, balance budgets, pull out of these crises that are going on in other nations and such. I mean, right now we got Israel here to advocate for support, so that
Yeah.
may be more spending and yeah. So I just have no faith there, and I think that my faith is in what I can do personally, not what any of these candidates can do for me.
Yeah, I mean that makes sense. And I mean, I would sort of just say one thing, and that is that candidates seeking election always promise more spending. The reality when they get elected, if they've got any sense at all, is to tone that down and try and control the spending and blame it on the last lot, if you like. But I'm not sure that even this modicum of sense is actually in either of the two leading candidates for the coming presidency. I mean, I think President Trump or ex-President Trump, if he gets elected, I think he's going to rely on cutting. I mean, I'm just going on what he said. Cutting taxes, corporation taxes, income taxes, and replacing it with tariffs, more tariffs. But I mean, this was what they did in 1930 with the Smoot-Hawley Tariff Act, which killed not only the American economy, but the global economy. So, I think there's a sort of, if he goes down that route, it's not going to be pretty. And then you've got Kamala Harris, who is making statements like, we're going to stop price gouging and all the rest of it. I mean, she's going down a route which politicians have gone down. I mean, Diocletian did it. He came out with an edict of maximum prices in about 305 AD. And the result was that nobody in Rome could do any business. I mean, the butchers and the bakers and all the rest of it just shut up shop because they didn't want to get hanged, if you like, for breaking these rules. So they just shut up shop. And the result was that Rome had to empty because there was no food in Rome. So everybody left and foraged in the country, And Kamala Harris is the last of a very, very long line of politicians who have recommended this sort of policy. Now, again, she could be just electioneering, but I get the feeling that she actually doesn't know what she's talking about. I mean, she is a lawyer, not an economist. You could argue if she was an economist, it would probably be worse with today's bunch of economics so-called experts. But when you get lawyers in charge, they're completely clueless, and this is not good. So, I mean, either way, while I would fully accept that, after the election, they deal with reality, and the story might be slightly different from what they're telling before the election in order to get elected, I really don't see much hope for the US economy on the election. I would throw in something else, Daryl. I'll throw in something else very briefly. The debt ceiling is due to be refixed, I think on something like the 6th of January or 3rd of January. I mean, literally when the new president takes office. Now, if I was a sort of free spending candidate and I get elected, I want to create headroom. So I want to put the ceiling up as high as I bloody well could. And we're already at what, 35 and a half or something trillion. Um, how about 40?
Wow. Yeah, this is
No, look, I'm going to tell Congress I don't want to be constrained.
it's
I got things to do.
hmm I
I
I
got wars to fight,
so
or,
so
or not.
I understand like how people felt and during the global financial crisis and even before that when they were concerned about the billions that were added to the national debt. And for me, I'm sitting here concerned about the trillions, it's
Yeah,
I wasn't in the
yeah,
financial industry at that time, or whatnot, but I could see how they felt like at that time. And now I'm like, okay, how big can this number go before, it just collapses? It's a house of cards.
yeah, yeah. You're right. I mean, it's well, the point about debt is that debt is okay so long as it is used productively. But government debt is not used productively. And by that, I mean it is not demanded in an economy by consumers. It is supplied by government on their diktat. And this is not productive. It is inflationary. And also, as I said earlier, when consumers start drawing down on their savings or increasing their borrowing in order to consume, that also drives up prices because it's not being matched by production. I mean, it's not for nothing that you don't have an inflation problem in China or Japan. Why? Because there is a decent savings ratio. People actually save some of their money. In the case of China, I mean, it's enormous. Um, and what this means is that you have got production on the one side with too little immediate consumption, if you like, uh, for prices to be maintained. They're going to tend to drift a bit lower the whole time because there is the lack of the demand because people are saving. And the way it works actually is it balances out very nicely because those savings are redeployed by industry in order to improve manufacturing capabilities, technology, and all the rest of it. And the result is you get better products at lower prices. I mean, just look at I know everybody says the Chinese government subsidizes this and subsidizes that. It's you know every government subsidizes something along the way, and I don't think China is actually hugely different. But when they can sell, these electric cars at a fraction of the price that General Motors demands for their whatever it is they're selling, I mean, you know that these guys are actually in a savings-driven economy, just like Japan was back in the 70s and 80s, um, producing stuff which consumers want at a price which undercuts old-fashioned industries who just don't want to evolve and don't have the means of evolving because the only way in which they can invest in production really is through bank credit created out of thin air, which is fine. I mean, it always happens. It's created out of thin air. But the problem is what happens on the other side of the balance sheet. If people are actually going out and spending that recycled credit, as it were, rather than retaining it to keep it, if you like, in some sort of balance in terms of funding investment, then you're going to get inflation. And I'm sorry to say that this is where the United States is today. It's where we are in this country. Um, it's where some of the European Union countries are, that's for sure. But principally, I mean, the two really, yeah, well, I mean, the really big economy, which is consumption driven and very, very dangerously exposed to these conditions, is the US economy. I mean, I would be very surprised if we don't see US Treasury yields rising to well over 10%. In the next 2 or 3 years, I guess. I don't know when it could happen. I mean, again, it comes back to this question: what's the value of the dollar? It's based on the faith, if you like, that people have in it. How's your faith doing?
It's shot. It's gone. So I do want to, as we begin to wrap up, I do want to touch a little more on silver. I was reading this article on the Wall Street Journal, and there's been a lot of talk about the industrial demand for silver as that being like a bearish kind of thing, is in terms of why the price isn't moving higher. And I read on this article that the silver supply hasn't kept up with demand for the past 4 to 5 years, going on 4 years, and they're talking about how the supply is being eaten up by investors, as well as like solar and other electronics. And pretty much, I mean, it says like we're approaching towards a deficit. There are stockpiles, allegedly stockpiles in London and such that can help supply the deficit. But I wanted to get your outlook on silver from a supply demand perspective, because a lot of the talk about industrial usage tends to be a little more bearish on silver.
Yeah, I didn't see the Wall Street Journal article, but I mean, what you're saying about being in deficit for the last 4 years, I mean, that's basically something that the Silver Institute has pointed out in the tables which it accompanies its annual reports. The way they lay these tables out, you see there's a sort of, the gap, as it were, between visible demand and visible supply, which is like that. They pencil in a number which is investment, and it's not investment at all. I mean, quite a lot of this is industrial stockpiling, actually. And the problem with silver is that any industrial stockpiler, the idea that they might try and push the price down because it's in their interest to have a lower price, they're too frightened to do it. They don't want to do that because they'd lose it and they don't get it back. They know that. So, I mean, I would say that the investor demand for silver has actually been extremely low, not just in this country, but also elsewhere. I mean, we've had India has upped its imports hugely. Why? Because they're making solar panels. I mean, they're trying to compete with China. This isn't investor demand. The investors haven't really got in there yet. I mean, the idea that investors buy silver, if this was really true, it would be more priced as money than it is at the moment. It's just purely priced as an industrial metal. And if you look at the gold silver ratio, I mean, as we speak, it's 83.9 times. Now, when you bear in mind that the ratio, if you like, when silver was money was around about 15 to 1. And if you go back to Diocletian, it was 12 to 1, which is interesting, which is roughly the proportion, I think, of silver to gold in the Earth's crust. I mean, basically, what's going to happen with silver is that as gold goes up, and it's not so much gold going up, it's the dollar going down, silver goes up roughly twice as fast. Because nobody's got it. It's a very tight market. The bullion banks are getting squeezed, something horrible. They are not quite as squeezed as much as they are in terms of the total market as they are in the gold contract, because in the gold contract, the mines aren't really hedging their position. Mine management, which actually has stuff which comes out, and they got enough cash flow in order to pay the wages and all the other expenses, they're not going into the market and hedging the gold price. But when it comes to silver, a lot of them do, for the very simple reason that most silver doesn't come from silver mines. It comes from copper mines, from nickel mines, from lead mines, and gold mines. So you can see that this is silver, if you like, is something on the side, and you're not really interested in what the price of silver is. So what you'll do is you'll sell it forward into the market, and this is what they're doing. So the swaps and bullion banks aren't, they're not in quite the same position that they are with gold. But that said, the the liquidity in the silver market is extremely tight. And it's not going to take very much investor demand to drive it a lot higher. Now, I think I said earlier that silver, popped up and had sort of broke into new high ground. I mean, new high ground since 2012. The chart pattern under it is immensely bullish. I mean, make no mistake. This, once it clears the 32.5 level, I don't see very much to stop it going up to 50. So, that's just reading the chart. That's just reading the chart. I'm not the only person who will be reading the chart that way. So you can see that, we're getting pretty close to a position where there's likely to be an avalanche of demand by investors who do not have silver. And they don't have gold either, incidentally. I mean, the amount of gold that anybody owns is really very, very low on average. I mean, we're talking about what, 1% of portfolios or something. I mean, it's peanuts, when really you should be seeing an average of somewhere between 5, 10, and even 15% if you're really, sort of worried about the future. Where's that going to come from? I mean, it's just not there. And it's interesting because if you look at the ETF demand, fiscal ETF demand, it's turned around from net sellers over the last 4 or 5 years. They're now beginning to be net buyers. And where are they going to get it from? It's not there. It's not there. So I think we've got a squeeze on the system here, which actually could be life-threatening for some of the weaker members in the system.
So on that note, everyone, Alasdair Macleod just presented a very strong case for owning precious metals to obviously, protect yourself, your capital, your families and such. And so I encourage you to look into that further. Alasdair, where can people find more about you, more information?
Well, the best place to go and really to sort of track what's going on in this market is my Substack channel, which is alasdairmacleod.substack.com. If you have difficulty spelling my name because it's very Scottish, just Google Macleod Finance, and you'll get there.
Got it.
That's MAC, not MC, by the way.
Yep. And
MAC. Yeah.
Are you still active on X as well?
Oh yeah, I'm still at Macleod Finance. Yes, so I'm active on X, and articles which I put on my Substack, I flag there, so that's another way of finding it. Yeah.
All right, sounds good. I'll be sure to link to those in the description below. You all be sure to go check out the Substack and the X profile of Alasdair. Appreciate you for coming on to the show again.
That's my pleasure, Daryl. Thank you for having me.